Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia in collaboration with RHB Asset Management. And this webinar is managed by our company, LifeChamp. So today, our webinar title is Stock and Bond Market Outlook for the second half of 2023. So welcome everybody to this session. My name is Shen Chu. I'm the moderator for this webinar. Now, after a tough 2022, this year it has been very eventful. So what is the outlook like for stock and the bond market for the rest of the year? What are the strategies to be deployed to navigate both markets that's driven by sentiment and volatility? So before we invite our expert to share with us their perspective, let's just run through some disclaimer. So whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. And today, we are very honored to invite the Chief Investment Officers from RHB Asset Management to share with us their perspective. Okay. The first guest that we have on our webinar today is none other than Mr. Mohd Fauzi bin Mohd Tahir. So Mr. Mohd Fauzi joined RHB Asset Management in February 2017 as a Chief Investment Officer of the Equity Department. As a CIO of Equity, his primary role is to set the strategic direction for the equity investment team in Malaysia, covering fund managers and analysts for both conventional and Islamic funds at RHB AM. His other roles, amongst others, include integrating the Malaysian team with the rest of the RHB AM Group Asset Management Investment Team, as well as ensuring the investment team operates in a prudent and compliant manner. He has a total of 30 years of working experience in managing life, private, government-linked funds, as well as portfolios for retail and high net worth individuals. Mr. Fauzi holds a Bachelor of Accounting and Finance from Leeds Metropolitan University, Leeds, England. He's a graduate of Chartered Association of Certified Accountants. The second guest speaker we have today is none other than Mr. Michael Chang. He's a Chief Investment Officer of Fixed Income from RHB Asset Management and has more than 23 years of fund management experience, specializing in fixed income investment for insurers and asset management companies. As the CIO of Fixed Income, Michael's primary role is to set the strategic direction for the fixed income investment team in Malaysia and RHB Asset's regional officers covering both fund managers and credit analysts. His strong investment acumen is recognized by the market and has been awarded as the most astute investors in the Asian local currency bonds. Malaysia ranked #1 for 4 consecutive years from 2014 to 2017. This win for the award, led by the Asset Benchmark Research, placed him at the top of the top 10 astute investors in Malaysia successively for the past 4 years. He continued to maintain a top 10 highly commended ranking for the most astute investor in 2018 and 2019. So Michael graduated with a Bachelor of Commerce degree from the University of Western Australia with double majors in accounting and finance and a minor in business law. So welcome both gentlemen to our webinar today. All right, so let's kickstart this webinar by beginning with the equity market outlook first. Okay, so let me just pose the first question to Mr. Mohd Fauzi. So we know that the US indices are at 52-week high now, staging a very strong bull rally. So what is the US market outlook like for the rest of 2023? Will America face a recession? So this is a common question that investors ask nowadays. So what is your view?
All right. Good evening, everyone. Thanks, Shan, for the introduction, and thanks everyone for listening to our view actually on the outlook, market outlook, and on the equity as well as the fixed income. But I think before I answer Shan's question, let me share the screen actually.
Yes.
That we have prepared for everyone. Is it clear? Okay. I think like what Shen mentioned just now, the US stock market has been rallying this year, especially in the past 2 months actually. The Dow Jones Industrial Index up about 6.8% year to date, and the S&P 500 up by 18.63%, and the Nasdaq Composite Index up by 34%, which is much higher than the other two indices. But what we also noticed was the rally was not really that strong initially in the beginning of the year until around May, middle of May. After the US market, after the US actually released the May inflation numbers, which went down to as low as about 4% year on year, then at that time we can see US market actually rally strongly, with the expectations of the US Federal Reserve actually likely to end its interest rate hike soon. So that basically actually contributed to the strong rally in the US market for the past 2 months. But what we also think about the US market, we are of the opinion that US Federal Reserve actually will keep the interest rate high at the moment. We should be seeing actually another interest rate hike by end of the month at the moment. So it may take the interest rate in the US goes up to about 5.5 or 5.25 currently. But I think like what I mentioned just now, the expectation was next year actually, US Federal Reserve actually might cut interest rate from around 5.5% to around 4% by end of next year, by end of December next year. So I think that was the reason that contributed mainly to the strong rally actually in the US for the past 2 months. But I think there is some inconsistency actually between the market, what the market is expecting, and also what the Fed is implying at the moment, because Fed is implying rates higher than the current levels, and then they will continue actually to reduce the liquidity in the economy in order to fight the inflation. But I think market is expecting Fed to cut the interest rate started from next year actually, and then until end of next year. There is a likelihood also that what we think recession is going to happen in the US, maybe in the first quarter of 2024, because from the charts that you are seeing at the moment, every time actually when the Federal Reserve hike the interest rate aggressively, it will be followed by recessions in the US, because what you can see here, the blue line actually is where the Fed actually aggressively push the interest rate higher, and then it followed by the US GDP going into this recession. So there is a likelihood that this time around it may happen the same thing after aggressive rate hikes by the US Federal Reserve. But one thing that I think we worth to note also, after the aggressive federal rate cuts actually, it will be followed by also interest rates cuts in the following when the economy gone into recession past years actually. So what we think going forward, and what the market also thinking going forward, the impact will be on the US GDP, and that also it is likely that the Fed may cut interest rate also aggressively, started with the thing in this maybe in the towards the end of the first quarter of next year, or in the second quarter, as early as second quarter of next year. there is the probability is also quite high also for the US to go into recession next year as a result of the aggressive rate hikes by the Fed actually. At the moment, the recession probability actually is higher, still at around above 60% for the US economy to go into recession. But the questions now is whether US will go into soft landing or whether US will go into hard landing. Only I think the time will tell us whether the US economy still resilient despite the aggressive rate hikes by the US Federal Reserve. Then on the right hand side of the chart also, you can see the recession in the Euro market also, or Euro economy also is quite high, but the recession in Asia, especially Japan and China actually, we may see, I think the economy may avoid recession next year for Asia, but not for the US economy and also for the European economy.
All right. So looking at this recession probability data, Mr. Fauzi, are these data drawn from the official figure given by their research institute or think tank or their central banks?
Yes, all the data here are provided by the what they call it, the US
Federal Reserve
and Fed Reserve and also some from the Department of Statistics also in the US.
Okay, so they did the modeling and they think that there's a 60% likelihood that they will enter recession.
And they will enter
recession.
All
right.
Yes,
so you just mentioned that the likelihood of a recession in Asia is low, especially China. So can you share with us what is the outlook for China in the second half of 2023?
For China, okay, like what we saw just now, although the recession probability is lower, which is less than 20%, but year to date the stock market is not, I think, doing good actually. In China, we saw just now the US index, the Dow Jones year to date up 6%, the S&P 500 up 18%, and the Nasdaq up 34%. But US Shanghai, but because what I monitor is the Shanghai Composite Index year to date only up 2.42%. So the difference is quite huge actually between the performance of the stock market in China and performance of the stock market in US. I think like what I mentioned, why the stock market in US was really quite strongly due to the expectation of more of interest rate cuts next year. But for China at the moment, the economic data that come out from China, I think, is quite weak. After they reopened their economy last year, the expectation was quite high that China economy is going to rebound strongly this year. But actually, for the past 6 months, actually, the economic data in China was actually below expectations. In fact, the recovery is weak actually, if we compare with what the economy is actually expecting from the reopening of China from last year. In fact, for what you can see from the chart here, the manufacturing activities actually continue to contract. In fact, the factory activity in June contracted for the 3rd month. But what we also think there is a likelihood that further stimulus may be introduced in China. I think the Politburo meeting that was held yesterday actually the Chinese authority actually sort of like promise, or not to say promise, but I think what they've been saying, what they want to stimulate further Chinese economy due to the weakening economic condition in China. The official manufacturing purchasing managers for China actually came in at around 49 in June compared to 48 in May, and also 49.2 in April. So you can see that the manufacturing PMI numbers in China is below the 50 level mark, which is in the contraction zone at the moment. And then also I think the non-manufacturing, which is the services sector, also coming in at 53.2 in June compared to 54.5 in May, and also 56.4 in April. So the recent data actually that came up from China is much below expectations. So there is a concern that if the Chinese government actually doesn't do or doesn't stimulate the economy, I think the economy might go down lower from the first half of this year. And also because of the slowing global economy also, what we saw also, the export also from China to other parts in the world also slowing down quite significantly also, and also the weak manufacturing activities also were the result of the dwindling export demand, and also property slumps in China. And then also like China, normally they will rely on consumption, but I think at the moment in the first half of this year, consumption also not helping actually Chinese economy. If you look on the left-hand side of the chart, I think the retail sales for May, although it rose about 12.7% from a year ago, but it was still below expectation of 13.6% growth forecast. And also China consumption did not recover as expected due to the lack of stimulus aid to consumer. And also the surge in unemployment also is quite worrying actually in China, and also the soft housing market also that actually has affected overall the sentiment in China, and also I think that also contributed to the deflationary environment in China. I think the most worrying part also in China is the unemployment rate among the youth in China. The unemployment rate for young people ages from 16 to 24 rose to 28.8% in May, a record, which is a record actually, and is above the high set in April. And also the jobless rate for people of all ages in cities was about 5.2% in May. So I think the risk is for China is if the government do not introduce massive stimulus to show up the weakening economic recovery. But I think like what I mentioned just now, the Politburo meeting, I think they know that the economy is not doing well. I think they sort of like they will introduce more measures actually to stimulate Chinese economy. I think that's for China, Shen.
So what we learned is that it's a mixed signal, huh?
At the moment, still the signal is still mixed in China, but I think towards what you call it is not encouraging actually. From what I can see from the economic data in China.
Right. So we'll wait for their stimulus package.
Package, yes, correct.
All right. So you share with us the US outlook and also the Chinese market outlook. So how is the Malaysian market outlook like?
Okay, I think before I talk about Malaysia market outlook, I think we just touch a bit on the macro first. Malaysia economy is expected actually to slow down in the second half of 2023. We saw, I think, our GDP growth was at 5.6% in the first quarter of this year, compared with 7.1% the fourth quarter of 2022. But if we look from the seasonal quarter-on-quarter comparison, the economy grew marginally only by 0.9% in the first quarter this year, after contracting by 1.7% in fourth quarter last year. However, what we saw also, the domestic demand is quite resilient at the moment. So this may offsetting actually the contractions in the export, because what we saw also, I think the export has not been doing well. I think we saw already the export in China, which is down significantly due to the global slowdown also. But I think for Malaysia also, our export also has been coming down actually, and then I think because of the external demand is weak at the moment, and also I think because of the other reason, maybe because of the continued inventories adjustment in the global semiconductor sales, and also because of moderating prices actually of commodity as well as energy. So I think that there are a few combination of factors that pull down actually our export in the first half of this year. But I think like what I mentioned just now, the consumption I think remains resilient for Malaysian economy. I think because of our unemployment rate also quite low at the moment at 3.5%, and income growth, although slower pace, but it will continue to support the growth in the consumer spending. And then on the inflation also, I think at the moment our inflation quite manageable. The latest inflation numbers was, I think, lower at 2.4%. So I think inflation is manageable for Malaysia. And but this, I think, like what Shen asking just now, why our stock market actually has not been performing well in the first quarter, in the first half of this year. I think one of the, there are many reasons actually contributed to the stock market performance, but what we think in the first half of this year, due to the weak ringgit actually, ringgit, as what you can see from the bar chart here, is the second worst performing currency in the first half of this year. Japanese yen actually was the worst performing. We are about 6%, almost about 6%, compared with other regional currencies. We are not doing well actually compared with other regional currencies. But I think in terms of positioning actually for our strategy, it will be good for the exporters. As ringgit weakening, the exporters I think will gain more in terms of revenue. And then also, if you look at the stock market also, our currency is the second worst performing in the first half of this year. And also if we look at the stock market also, Malaysia was also the second worst performing compared with other markets in the region. Although other markets in the region not doing well actually, but it's not as bad as our market. We are about close to 6% down in the first half of this year. The worst is Thailand, above 10%. But the market that performed strongly in the first half of this year was the Nasdaq, like what I mentioned just now, Japanese market, Taiwan, Europe, the S&P 500 as well as Korea. But what you can see here also, most of the market here that perform related to technology sectors. So the market that have more exposure in the technology sectors actually perform well in the first half of this year. So to go a bit detail actually on the performance or the review of market, Malaysia market in the first half of this year, the smaller cap stocks actually have performed better than big cap stocks in the first half of this year. If you can look from the bar chart there, the small cap only down by 0.5% this year, but the big cap, which is represented by the KLCI, actually down by around 6%, almost 6% year to date. And in the top 30 actually, FBM KLCI Constituent Index, only 2 stocks registered a positive returns year to date, which are I think the defensive stocks that are in the top 30. But I think one thing interesting to note also that within the small cap space, there is a huge difference also in terms of performance between the small cap and the micro cap. The small cap represented by the FBM small cap index, the micro cap stocks actually represented by the FBM fledgling index. So you can see a big difference actually between the performance of the small cap and also the performance of the micro cap. But one thing that I think worth noting also, there was a big swing actually in terms of performance for the small cap index. In the first quarter of 2023, the blue bar, the chart actually was positive. But in the second quarter, actually the small cap index down by almost close to 4%. But I think if you look at the FBM KLCI index in the first quarter, it was down by more than 4%. But in the second quarter, although it's still down, but it was lower than the first quarter of this year. And then in terms of sectors performance also, what we can see, the defensive sectors actually perform better than the growth sectors in the first half of this year. Then like what I mentioned just now, I think the performance of the big cap was affected also because of the foreigners actually exiting the market in the first half of this year. They've been consistently selling our market, and year to date, as at 30th June, about 4.1 billion actually they net sold our Malaysia market. But I think in terms of outlook for the stock market, what we are seeing actually, the index is at the moment, as at 30th June, when the market closed at 1,376, the market was trading actually at the prospective PE of around 12.7 times. 12.7 times is actually the same PE level that the index touched when the index went down to as low as 1,219 when the pandemic hits in March 2020. And also at 12.7 times, the market is actually lower than the average PE of 14 times for the past 3 years. So actually, if you look at the chart there, the market after the pandemic, it hardly trade to the mean valuations already, which is represented by the red line. The market always trade from -2 standard deviations below the mean to -1 standard deviations below the mean. And then also, if we look at the earnings, which is most important indicator or most important factors actually for the stock market, what we have seen, what we think actually the earnings downgrade has already, I think we have seen the earnings downgrade, which started from February this year. We think that earnings downgrade might be bottoming at the moment. And then also, I think one thing good about Malaysia, if we compare with other markets in the region, KLCI is among the best in the region that offers good dividends to the investors. So we believe, I think if the defensive sector will do well under current high interest rate environment and also market uncertainties. I think like what I shared just now in when in the beginning, actually, I think this is quite interesting to note because Fed is expected to cut rate from end of first quarter next year. Historically, USD may weaken actually once Fed cuts interest rate, which is likely to happen in 2024. Additionally, also what we monitor, the DXY index, which is the US spot index, actually failed to go higher despite Fed hawkish statement for the last 2 months. So if the US dollar weaken, if Fed starts to cut interest rate next year, then I think it will be good for the stock market outlook for Malaysia as well as Asia, because historically, actually, when USD weakening, actually, we could see the Asia ex-Japan index goes up, and also Malaysia stock market also goes up. So that's basically, Shen, from me. Thank you very much.
All right, thank you so much, Mr. Fauzi, for sharing your perspective into the market outlook for both, for all three markets, which are the American market, the China market, and also the Malaysian market.
Yep.
So now that we have learned from Mr. Fauzi about your perspective, so let's about the stock market. So let's look into the bond market. All right. So let us delve deeper into the outlook for the bond market. Now, I guess many retail investors like us may not have paid close attention to the bond market. So let me just pose this question to our next guest speaker, Mr. Michael. So could you share with us about the fixed income market development in both the American market and also the local bond market?
Sure, Shane. Thank you very much for moderating this session tonight. So first of all, a few words of thanks to Bursa Malaysia for having us, RHB Asset Management, on the program, and also thanks the audience for also tuning in to today's webinar. So if I may, I would just go through to answer your first question, Shane, in terms of what has been the bond market like for 2023. So unlike a year where there were a lot of challenges in 2022, where we saw interest rates were rising aggressively from the US and then also from Malaysia, the fixed income market for 2023 started off on a more bullish note. We actually saw yields actually coming off lower compared to where it went higher in 2022. So what were the main events that has happened in the first half of 2023? We saw the Fed importantly held the rates unchanged, the US Fed funds rate, for the first time since it started hiking rates last year. So 15 June 2023, we actually saw the US Fed Chair Jerome Powell actually maintain interest rates. But having said, I think there's also a lot of expectations that what he will do this month itself, after having increased interest rates since March 2022 by 500 basis points, that is 5%, to where it lands now at 5.25%. So if they do increase interest rate further by 25 basis points, then we will eventually see this month, in end of this month, that US Fed funds rate could rise to 5.5%. So inflation, I think, somewhat has shown some relief in June 2023. A slight typo here. It has actually turned around in terms of inflation expectations, because I think I think the first week of July we had the inflation number coming out from the US. It was actually a much lower number compared to market expectations. So that has also sort of reverse some of the more hawkish views on the Fed. I think in June, when they actually held the rates unchanged, they have also sort of gave guidance to where interest rates would be heading. The US Fed and including the Fed chair, were guiding the market that on the dot plot that, we fixed income investors always observe what they say, it would be as high as 5.75%. So where it is right now at 5.25 to 5.75%, that is another 50 basis points hike coming from the US. And that is important because when Fed hikes, they will be follow-through effects for the other countries, especially the advanced economies, and then also for developing countries like ourselves, ASEAN, Asia. So there will be a ripple effect in terms of how important the Fed makes a decision in terms of interest rates. So what has actually been supporting this core increase in interest rates has also been a very good economic numbers that US has been still having those numbers shown. That include job numbers. I think in terms of what US is currently sort of enjoying is a very tight labor market. Wages are still decent. Unemployment rate actually falls to 3.6%. So there will be quite a good growth that we're seeing in the US, unlike in China, where the mirror of it is very different. We saw China having concerns about potentially, young labor force that may not be able to find jobs and all that because of incoming graduates into the Chinese market. So those are the things that are a little bit different, what's happening in China versus what's happening in the US. And that is also how moves in terms of central banks has been quite different. In the US, we saw them hiking 5% in terms of official interest rates. In China, we actually saw rates easing from the official policy rate. So back to Malaysia. So what has it been for Malaysia in the first half of 2023? We actually saw BNM hike collectively 125 basis points from last year to this year to 3%. And it also hiked once a price move in May by 25 basis points to bring to the official policy rate right now at 3%. So in terms of what has been, in terms of data, Malaysia's inflation has started to ease. We just had the inflation number earlier this week. So inflation actually dropped to 2.4% in June. Previously, it was 2.8% in May. And it's actually a large drop compared to where it was last year in August 2022, where it was 4.7%. Then we also have pretty decent growth in terms of Malaysia's GDP for first quarter. As what Encik Fauzi has mentioned, we actually achieved 5.6% year on year. And if you talk about the cumulative average growth for Malaysia, so far from reopening of the economy to right now, the CAGR is running roughly around 6%. Although you actually see much lower numbers in terms of nominal GDP for as the year progresses, but you talk about potential. You calculate based on cumulative growth basis. Actually, the Malaysian market has been decent in terms of economic growth. So because of that, I think the expectations that also BNM is likely to not change in terms of interest rates going beyond 3%. The Malaysian government bond curve or the Malaysian government securities curve has actually flattened since the start of the year, where it actually tightened by about 18 to 34 basis points for the yield curve. So just to chat a little bit more of where yield has gone, if you compare the 10-year MGS yields versus the US Treasury 10-year, that means same tenor for both government bonds, I mean Malaysia versus US. In the past, you actually saw pre-pandemic there was actually a spread between the MGS yield versus the US Treasury yields. But that has actually compressed. And right now, I think both of the yields for the 10 years are actually at parity. That means both are yielding around 380 to 390 level. And why have they converged? That is simply because the aggressive moves coming from the US has actually led the yields to rise in the US. And that is why there has been some shift in terms of global liquidity as well. And then just to also illustrate to everyone tonight that besides the VNM interest rate increase, what were the reasons why they have increased to 3%, and then why they have done the 25 basis points in May. I think these are all calculated moves because in May, I think the core inflation was still high. Typically, our core inflation for Malaysia before this round of inflation talks in 2022, 2023, the core inflation is roughly about 1 to 2%, but because our core inflation Malaysia has also gone higher to currently about 3%, that is still somewhat high compared to historical numbers. And that is why also interest rate was actually raised 25 basis points. It was a surprise move to market, but we also think that it's also a preemptive move for them to also look into potentially easing rates when globally and when US starts to ease rates, there is also capacity for VNM to also cut interest rates if the global economy or Malaysia's economy starts to see some potential slowdown. So the capacity for central bank to actually make an impact in terms of cutting rates matters in an environment when economically it's more challenging. So this is also to see where yields have gravitated, in terms of OPR, which is the lowest line. You saw that steady increase in terms of OPR coming through higher. But for the rest, in terms of the yields for the yield curve, typically for government yield curve, we have 3-year tenors, 5-year, 10-year, 20-year, even stretched out to 30-year. You can actually see there was actually a downward shift in terms of the yields going lower on this part, contradicting to the moves on the official rates has gone higher. So bond markets typically respond faster than the official policy rate. So when official policy rate does go higher or peak, we actually see the reverse of bond yields actually going lower because it's actually an expression of the views by the fixed income investors in the market that interest rates could have peaked. Yeah. And that also has an impact to our corporate bonds because not just Malaysian government bonds in the bond market in Malaysia, there are also corporate bonds that are of various ratings, AAA being the safest, and then AA being slightly more risky, and then we have also single A. If you look at the pattern of these versus the MGS, they actually saw a similar trend, which also means that yields has also gravitated lower compared to where it was in 2022. 2022, most of the time they were spiking up, but you can actually see that the turning points of the yields have started to kick in, and we believe that there will actually be more compression in terms of corporate bond yields going forward. Yep, so back to you, Shane.
Okay, I see that the yield curve inversion slide. So now we know that the yield curve inversion is one of the indicators of a possible US recession. Ever since the World War II, the US yield curve inversion has accurately predicted many the US recessions. So how is the yield curve inversion this time round?
So yield curve inversion, like you see here in terms of the yield curve, you can actually see that it has actually come before economic recession. So in this case, they are actually plotting against the 10-year US Treasuries. So how, what does yield curve inversion mean? It means that when your short-term government bonds in the US has a higher rate than your long-term, which is the 10-year US Treasury, typically in an environment, you don't normally see an inversion in yield curve, unlike a situation where you see them in because normally in basic finance, you are rewarded more for parking money or investing longer, and that's why you are paid on a higher return for parking a longer FD or parking a longer bond. But in this case, we actually saw 2-year treasury yields being higher than 10-year government bond yields. So for example, your short term could be about 5%, but then the long end is 3.8%, 10-year. So there's been a negative. So when you see actually these inversions that are all shaded in red, you can actually see that these actually precedes the economic recession. So you see this inversion coming through, then actually the recession actually comes. So these are actually all the shaded, these are the recession points. So just to give a little bit of context, like for example, in 2020, when we were hit at the beginning of the pandemic, there was actually a short recession. It was also reflected in the yield curve, but then the recession was very brief. I think it's lasted only for like 3 months, a quarter. And then we actually saw yield curve actually normalize because US has actually cut interest rates in unprecedented manner to close to 0% to mitigate the impact from COVID-19 pandemic. So it will be interesting to see how the economic activities perform, but generally in a yield curve environment, and if it's inverted, it actually precipitates a economic recession or possibly a slowdown in the economy. So I've just plotted this also, to illustrate the inversion. We actually plot the 10-year versus the Fed funds rate. So current Fed funds rate is at a high of 5.25, but the yields for the treasuries are running at about 3.7%. So this is another form of clear inversion that you can actually see by the shades in gray in this particular graph. So unlike the US, OPR has been gradually raised. This is actually illustrated in this orange line. And currently we are sitting around 3%. And then we talk about the government bond yields. It has peaked last year in end of Q4 last year at 4.565, right now to 3.7. So this is actually where you actually make money from the bond market. The dive is almost close to 80 basis points of adjustment in terms of yield, and that is reflected in a 10-year government bond security for Malaysia, and that translates to an increase in price of government bonds as well. So you look at this, we are actually quite different from the US yield curve. At least our yield curve is still upward sloping, and not the case of an inversion that you are seeing in the US.
Ours is healthy and normal.
You're paid to actually invest for longer term, and you get rewarded by parking your money for longer term. That's essentially what it means. Yeah.
Okay. Can you tell us more about the Malaysian inflation?
Sure. I have the next chart right before you. So in terms of inflation, you can actually see that as what I've spoken just now, the inflation rate has started to ease in June, significantly more to 2.4%. Previously in May, it was still hovering around 2.8%. But these numbers are actually a lot lower than what you saw in 2022, right? I mean, the basis for all the interest rate increases, whether is it in US or in Malaysia, they have one thing in common. Inflation was a little bit out of hand, and we all know the reasons why. COVID-19 pandemic caused supply disruptions, and then your goods which you order, your cars never came. So these were the main reasons that have actually also why there was an increase in demand that was so excessive that it actually there wasn't enough supply for everyone. In terms of core inflation, also significant. We actually saw that receding from a period from last month 3.5% to currently 3.1%. And I think these are the signs that normally central bank look at in terms of deciding what would be the roadmap for the OPR. Clearly, these signs have actually give some relief in terms of running the mandate for the country in terms of setting the interest rate policy. And if we see these numbers actually going lower in terms of inflation, it does give the central bank more, more tools or more flexibility in terms of, dealing with the current interest rate. So that's why that forms a basis why we think that, likely that the OPR will stay unchanged at 3%. Yeah.
All right. So how is okay, so this is the auction calendar for the
yeah, so I think this is much
for the bonds,
alluding
right?
to some of the opportunities that we also saw in the market. In terms of government supply, typically when we actually see supply and demand being very healthy in the bond market, where demand outweighing supply, that actually gives a reflection of the market expectations, right? So in this case, most of the time, the bid to cover, that means the demand outweighing supply, has been 2 times. So what it means is that there's actually more demand that's coming in the market to buy papers than is supply. So it actually means that tendency for prices to actually go higher, gravitate higher, is there in short.
Okay. Michael, could you teach us how to read this chart? Maybe the first time I see this chart,
Sure.
right? What is BTC?
So BTC means bid to cover ratios. It essentially means that, let's say, for example, in this chart, right, we actually see, so actually on the left-hand side, you actually see the auction, how much is coming to the market. So for example, the latest one being GRI 728, it means that July 2028, a paper that was issued where the amounts were close to, in excess of 5.5 billion, for example, right? The issue size. We actually saw the bid to cover just hovering below 2 for this issuance, right? So this is actually the corresponding orange line that refers to the the y-axis that's on the right lah. So typically, if you see most of the times, if the numbers are above 2, it means a very good demand coming from market in terms of versus supply lah. The broad lines that you see bars are actually the supply that has been coming to the bond market. So for example, like MGS October 2042, long dated, right? Super long, 3 billion. That's when the bid to cover ratio is a bit more conservative lah, because not everyone can buy into a 30-year bond, a 20-year bond, and generally in terms of long dated government bonds, market tend to be a bit more conservative and more prudent lah. So that's why bid to cover can go a little bit below 2 times. So all these numbers on the right that you see, these are indications of bid to cover ratios, which means how much of demand outweighing supply.
So now we have a resilient demand for our government bonds.
Yes, so for 2023, you just need to look at these 2 numbers for MGS, which is Malaysian government bonds, and then GRI, which is the Islamic version of Malaysian government bonds. These are, healthy numbers lah, basically above 2 times. Yeah,
healthy number. Okay, so what are the so given the outlook, right? What are the opportunities and the risks for bond investors in the second half of 2023? What would be the sound strategy for us moving forward?
Yeah, so I've touched on the OPR, expectations of no further increases. I've touched on the inflation. These are numbers that typically what investors look at, or central bankers look at in terms of setting policy direction for interest rates. Then I've touched on the healthy demand supply dynamics for the bond market. So I think there are also some signs that we're seeing already in June. US inflation has peaked. Malaysian inflation also somewhat peaked in terms of seeing the June number, preemptive move by central bank to actually hike interest rates by 25 basis points in May. Although it's a surprise, we actually know why they have done so, because core inflation was a bit on the high side. So prudent to do so to avoid inflation being excessive, and then there's also capacity to cut interest rates if the level of interest rate has been rise high enough to actually mitigate a slowdown in the economy. But there are also things that what has kept US being more hawkish than Malaysia, for example, is because the resilience of the US economic data that has been coming through. But largely these were the, what we saw in June, somewhat of an inflection point for the bond market, and then also for inflection point in terms of rate hiking. So what are the opportunities or catalysts for second half of 2023? We see US Fed pivoting earlier than expected. That means they go on, keeping rates unchanged. They would do so in July, but I think beyond July, then I think the Fed will have to assess, because would they mean that they will, maintain rates as it is, or even maintain rates for slightly longer, but at least the upward pressure on interest rates for US is not as high or as aggressive as 2022. Then potentially we also see a global synchronized slowdown. So if these were to happen, this is actually quite good, because it means that Fed will also refrain from getting interest rates higher. And when Fed actually does a pause, generally the other bigger boys like your UK, Australia, Europe, all these will look at some point of peaking in terms of interest rates, right? And that is actually good for both equity and also bond market. But of course, bond market will be able to run first, as in like we will respond with higher prices of government bonds, because we've already seen the peak in terms of the sentiment on interest rates. And the other catalyst is further moderation in inflation, both for US and then also for Malaysia. What are the risks? Of course, there will be risks as well in this market condition. Volatility is always there. You can actually see markets finding direction, right? But I think in terms of broad expectations, what are the risks out there? It would be your inflation. If inflation is going to be stickier than it is, or suddenly there's an increase in inflation number or surprise, that could actually delay some of the peak in terms of interest rates for US, and then they may have an impact on markets, both for fixed income and then also for equity markets. Then we talk about the dot plot, when we mention about where they have forecasted rates to rise to 5.75%, which is 50 basis points from the current US Fed funds rate. If it goes higher than 5.75%, then or go to 6%, then it's very hawkish for all of us, which means that interest rate will still be on the rise, and there will be dislocation in terms of flow of funds again, because it doesn't pay you so well to be invested in this region, because US rates are much higher. So similarly, currently you can actually see US fixed deposit rates, or for your typically in US dollar is much higher than before. We're not seeing them being so high in terms of placing money in US dollar deposits, but we're already seeing that. And that is actually how mainly a function of the Fed funds rate. And of course, the last thing that has been causing potential volatility in the market is also the geopolitical tensions that continue to escalate, and bouts of volatility that can cause market. So to sum up, I think in the bond market, there are many things that you can look at. One of them is duration, like we highlighted. If the duration of your bond portfolio takes on a longer duration, the sensitivity towards interest rates and the ability to actually, have a positive outperformance, positive return will be even more compared to shorter dated government securities. Because the fact that you're parking money for a longer period, you need to be rewarded by higher yields. And if yields drop a lot more on a longer term, right, it means that you actually make more money from prices. So in a simple example is, if you put money in a 3-year bond versus a 10-year bond, if interest rate goes lower, you will make more money from the 10-year bond than the 3-year bond, because of the sensitivity to interest rates. Asset class, because we want to get a benefit of both credit and then also yields that are higher now. We also like the corporate bond as an asset class to be invested in funds in portfolio. And then in terms of bullishness, I think we are around 90% for our portfolios, like in terms of how much are you weighted in terms of bonds. In a more defensive market like last year, typically bond portfolios will be going lower in terms of exposure to bonds, mainly around 80 to 85%. But now this year we actually see peak in interest rates for US and then also potentially for Malaysia. We have actually ramped up the allocations to investment levels for bonds. And then risks on the right side of this chart, basically just to recap, were inflation, Fed funds rate being higher than 5.75, and then also bouts of geopolitical tensions.
All right, thank you so much for sharing your perspective, Michael. Okay, so I think it's time for question and answer session right now. So of course, if you have any questions asked both our speakers today, you may write them in the Q&A box, not the chat box, write them in the Q&A box so we can address your questions accordingly, okay? Okay, I think both of you just now mentioned about the possible US recession. So with the possible US recession looming and US market is at 52-week high or very near to the all-time high, and what do you think should investor do? Okay, should we enter the equity market now despite quite high valuation and the market volatility? Maybe Mr. Fauzi can take that question.
Regarding US, Chang,
yeah, at the current market condition, should we still enter the market because it could be recession could be coming, right? Like both of you has forecasted.
Right. I think market is running on expectation. I think like last year, US market was down quite substantially also due to the expectations of the recessions actually coming in the US. And also, I think like this year, what we have seen, the rally in the stock market also in US due to the expectations of interest rate cuts maybe next year, maybe end of first quarter of next year, and then towards the end of next year. So market is ahead of the reality actually. Normally market rally or market goes down because of expectation. But I think like what we have seen in the US, although the market has already gone up quite a lot, I think like what I mentioned just now also, everything, I think we have to look back at the earnings now. So far, the earnings, the reported earnings by corporates in US are actually quite good compared with market expectation. So that I think has sustained the index of the US market for the past, I think, 2 months, although it has already moved up quite a lot this year, but it keep on continuing to go up, like what you mentioned, at 52 weeks high, simply because the first quarter earnings was good, and then now is the ongoing, I think, second quarter earnings also in the US is also equally good. Then I think we move into the next stage, which is the valuations of the stock market. From what we monitor actually, the valuation of US stock market is not really that excessive at the moment. Dow Jones and also S&P 500 is actually just slightly below the mean actually. The only market in US that are above the mean valuations is the Nasdaq valuation. So I think if to us, two most important thing that we monitor whether market likely to sustain or not going forward is the from the valuation perspective, and also the other one from earnings growth perspective. So at the moment, these two is actually quite reasonable at the moment.
All right, thank you so much, Mr. Fauzi.
Thank you.
So I'd like to pose the next question to Michael. So should an investor still worried about the potentially high interest rate in 2023 and beyond, since there are a lot of high on inflation?
Sure, Shane, maybe I just share a slide on that. Yeah. So I think largely, like what we discussed just now, in terms of rate hiking, we saw the inflation numbers coming much lower than expected. Safe to say that the Fed should be actually more or less calm in terms of inflation expectations. And we saw the number in June in US also come off lower for US CPI. So, I mean, although the dot plots in the, guided by the US Fed and then the Fed, like the voters for increase in interest rates, guiding at 5.75 for 2023, is actually in contradiction to what market or the bond market is telling the US Fed. Currently, despite this potential going higher in terms of the Fed funds rate, we actually saw bond yields actually reacted lower, which means that also things that because the bond market is supply and demand that is dictated by market. So what they are saying is that fixed income investors generally in the US doesn't think that the Fed will hike and continue hiking, because we actually saw some of the banks in US have already been having a lot of stress. We saw the collapse of SVB, and then a few of these banks has also been very challenging for them. So continue hiking interest rates in an environment that is very volatile may not be the best prescriptive measure to tackle. So which we think that even potentially there's another 25 basis points or 50 basis points that should actually be quite muted to the bond market. And the bond market is more in favor of potentially seeing them, the US Fed actually cutting interest rates in 2024, reversing some of these actions that has been done in 2022 and then also 2023. So safe to say that any exacerbated moves coming from these market reactions, bearishness in the bond market, are opportunities to even add on. I mean, depends whether you are talking about your global bond portfolio or you're talking about a Malaysian bond portfolio. If these are actually noises, you know that in 2024 or 2025, the reversal in the interest rates would have been going lower instead of going higher, because these levels of interest rates are actually unprecedented and it doesn't look sustainable in the longer term.
All right. Now, Michael, I'm not sure if you got asked this question often, but with the current high deposit rate offered by financial institutions, what is the investment proposition for one to invest in bonds?
So in terms of proposition, I think in terms of if you park money in fixed deposit, you just get the promised return at the end of the maturity. You don't get anything more than that. You don't get extras. You can't have any more capital gain for your fixed deposits. So the disadvantage of you parking money in fixed deposit, you can lock in high, but then the thing is that what you get in terms of returns, you have a fixed returns because you cannot get anything lesser for the fixed deposit that you put in, but you don't also enjoy any upside in terms of capital gain by selling this paper, or unlike in the bond where you can actually, they're tradable instruments, you can actually sell them and then you benefit in terms of income. There is a coupon payment semi-annually for bonds, and then there's also potentially capital gains arising from changes in interest rates. That means the cash flows of the bonds are now discounted by a lower yield, which means that you get, if somebody were to buy off you, they will have to buy at a much higher price compared to where you invested or where you bought it. So between these two instruments, you can actually see that better reflected and better gain coming from bonds in an environment where rates are flat or going down compared to fixed deposit returns. Because if rates are going to go lower officially, it also means that your fixed deposit returns will go lower. So in that, tendency is for bonds to outperform versus the fixed deposit. I mean, we saw that episode happening in 2020 when there was a cut in interest rates to record low for Malaysia at 1.75, we actually saw yields also gone lower, and that is why during that period also bond prices has also gone up in that environment.
All right. So does it happen to the government bond or corporate bond also follow the same path?
So usually these two markets, government bonds will be the one that reacts first. That means they are more sensitive to interest rate changes. They are more sensitive to policy rate changes. That will be the one that will actually increase in prices first, followed by corporate bonds. Corporate bonds are a little bit of a lag because they also have credit risk in these bonds. But if you have chosen very good quality corporate bonds, you would also benefit from changes in sentiments of interest rates, which means also yields going lower, and at the same time you get a higher coupon income that regularly pays every semi-annually. I'm talking about potentially investing in US bonds, US dollar bonds, because currently the yield environment is every yield of these instruments are very high, right? Because of the increase in policy rates. And policy rates being high, they have also led the yields in general being more cheaper bonds are compared to many years back before even pandemic, where bond prices tend to be a bit more expensive, a bit more premium. If you want to buy AAA and all that, typically the safety of payment is very high. It becomes very expensive to buy. But now I think with the current interest rates, with some of these yield curve inversion that you're seeing in the US, there are actually opportunities that you can go for high graded bonds, and then on a shorter dated position. That means maybe 2-year or 3-year bond that gives you 5% is still very good value compared to fixed deposit. The only thing that cannot go wrong in fixed deposit is, you are just getting the maturity at its value that it comes due. Yeah.
Right. I've seen a couple of questions from our floor today who asked about the relationship between the bond market and the stock market. Do they move in the same direction, or they have an inverse relationship? So I think either gentleman can answer this question.
Maybe I'll start first because I talk a lot about 2022, right? So that year has been quite bearish for bonds and also very bearish for equities. I think it's the first time that the unprecedented actually happened, where there's actually no inverse in terms of markets. So typically in the market where equity doesn't do well, bonds do well in the past. But 2022 has been a somewhat of anomaly where both asset class actually underperform because of these unprecedented increases in interest rates. Can you imagine all the central banks all collectively decide on raising interest rates? We have not seen this happening in a long while, and that has actually the reason why equities and bonds have been so volatile, underperformed generally, and the only thing that actually outperformed was cash in 2022. Yeah, so maybe Fauzi could add to that.
I think Michael has answered most of the has answered most actually, because normally under normal circumstances like what Michael mentioned just now, when the equity market doing well, maybe the bond market may not do well actually, but 2022 is different. But I think going forward also, what Michael mentioned just now, if say that US starts to cut interest rate next year, then it will be good for the bond market as well. But I think not only for the bond market will benefit as a result of the Fed cut its interest rate, but the equity market also, especially like what I mentioned, what I put up on the slide just now, the relationship between the US dollar and also the Asian currencies and Asian stock market also. So once Fed starts to cut interest rate, actually, US dollar will start to weaken, and then that will attract the flows of money actually back into Asian market, and then we could start seeing Asian market equities market in Asia start to benefit as well.
All right, thank you so much, Mr. Fauzi, for sharing your perspective. The next question from the floor is about the technology sector. So will the technology sector in Malaysia perform better in the second half of 2022, given that in the first half they were quite beaten down? What is your view on that, especially those stocks that are related to AI or EV?
Right. Actually, we don't what do you call it, for Malaysia, there are not many actually technology stocks that are related to AI, and some I think related to EV. But there are few that we saw also related to renewable energy actually. Okay, what we are seeing at the moment, the semiconductor sales actually globally has started to bottoming actually somewhere in May. So but what we would expect also, the most of the technology companies actually we start to see earnings to go down, not because the raw materials actually which is their operating cost is still high, but what we are seeing now actually, the average selling prices for the products actually is actually going down. So there are a divergence between the average selling price and also the operating cost. So what we would expect going forward, profitability of most of the technology sector also will go down. But what we have seen, I think, for the past few months, especially in US, the technology shares actually has moved up ahead of or beyond fundamental already actually. So for the technology stocks to sustain its uptrend, we need to see actually the earnings also they can sustain, whether technology companies can sustain their earnings going forward. That is the big question mark at the moment. But from our understanding is the average selling prices has come down, but the operating cost actually remains the same. So this will affect the profitability of the technology stocks going forward. We have seen, like I think the what you mentioned just now, the earnings for the most of the technology stocks actually in Malaysia actually was below expectation due to what the two factors that I mentioned just now actually. But going forward, we do expect the average selling price to remain actually or to bottom in, because now the semiconductor sales starts to go up and has already sort of like bottom in May, but the operating cost is actually remains high at the moment.
All right, thanks for sharing.
Hope that answered the question actually.
Yeah, thanks, Mr. Fauzi, for sharing your insights into this sector. Seems that we actually overran the session for quite a bit, so let's just do one last question. So we want to apologize if you're not able to answer all questions. So I've seen a couple of questions from the floor also asking about how do retail investors participate in the bond market? Because for retail investors, right, most of the time we're exposed to the equity market, but bond market looks like, you need a certain threshold, right? So for retail investors, how can we participate in the bond market? What is the minimum amount to invest in bond markets? How do we assess the US Treasury? So these are the common questions that I've seen.
Yeah, so in terms of the question on how do retail investors participate in bond market, I mean, typically for Malaysia, they will go through the unit trust funds, whether the unit trust funds are domestic or foreign. if it's actually domestic, these these investors will actually pool the funds into a bond fund, and the bond fund, because the standard lot for Malaysian government bonds is 10 million ringgit, and then the corporate bonds is 5 million. And these are actually sort of the standard lots that the over-the-counter market trades in Malaysia. So usually for retail investors, the amount that we have, normally we will go through the unit trust funds. Of course, there are some investors that are a bit more on the private wealth side, and so access to these markets will actually be going through their private bankers or wealth managers that can actually buy a bigger amount of bonds from these providers. But generally, in terms of retail, it has to go through bond funds. And then on the US side, in terms of standard lots for US market is a little bit smaller. So typically in sizes of 250,000 US dollars, that will be a standard lot for US. So you can actually see that the number, in terms of standard value or tradable lot, US is actually much smaller compared to ringgit. But you convert 250,000 US dollar, that will also be around 1 million, slightly more than $1 million in ringgit equivalent. So typically most of the avenues is through bond funds, or even your private banking advisors and all that.
All right, thank you so much, Michael, for sharing with us how do we gain exposure to the bonds market. All right, so ladies and gentlemen, you just heard from Mr. Michael Chang and also Mr. Mohd Fauzi, who are the Chief Investment Officer of RHB Asset Management. Thank you so much, both gentlemen, for spending your time with us in this webinar.
Thanks, Shane, and thanks everyone today for
everyone.
joining us. Thank you.
Thank you.
All right, so for those of you who have not checked out Bursa Academy, you can actually visit www.bursaacademy.bursamarketplace.com or scan the QR code. Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey. On Bursa Academy, there are a lot of investing resources for you to access, be it in the form of articles, webinar recordings, events to attend, quizzes and coursework for you to do to qualify to trade the leverage and inverse ETF. So just visit Bursa Academy to find out more about what Bursa has to offer you. So for our next webinar, it is titled Trading Warrant in 2023, Trick or Treat. So it's happening tomorrow from 8:30 to 10 p.m. We have gotten a renowned issuer, which is also from RHB. RHB Investment Bank will share with us, trading warrants in 2023. Is it a trick or is it a treat? All right. So if you want to register for this session, please, I've just given you the link in the chat box. So you may register for this session. If you want to learn about how do you trade warrants, what are the key indicators to look out for, and how do you get access to the Hong Kong market without leaving the Malaysian shore, right? So stay tuned for our session tomorrow evening from 8:30 to 10 p.m. So I've just put the registration link in the chat box for you. All right, with that, I want to thank all of you here for staying tuned until the end of this webinar. Hope that you have found enormous value in this session and gain a bit of perspective about what the market outlook like for the rest of 2023 and position yourself better in the bond and also the equity market. With that, thank you everybody for joining this session and hope to see you in our webinar tomorrow. Okay, bye everybody.